Jeff Kleintop. He helps manage over $354 billion as chief market strategist at LPL Financial, and he joins us from Boston. Jeff, welcome to Bottom Line. Thanks so much for joining us today.
Thanks for having me on.
Jeff, the Institute for Supply Management reports its barometer slid to 56.2 during April, and that was the lower than most pessimistic forecast in a Bloomberg survey. Have expectations been too high?
You know, it does look like economic expectations have generally been too high for quite a while now. A lot of the data has been a bit disappointing. I'd include initial jobless claims into that mix of data. You know, we took a look back over the key indicators that each of the last 2 years precipitated that slide, that sell in May and go away environment. And initial jobless claims, one of those, quite a few other indicators also showing some red flags this year.
Jeff, I have to ask, does sell in May work for investors?
Well, you know, in each of the last 2 years it's worked. I think, you know, looking longer term, maybe there's a slight bias for the market to do a little bit more poorly over the summer months than other times of the year. But, you know, when we take a look back and see which indicators really help to foreshadow this decline that we've seen in each of the last 2 years, remember the market peaked out at the end of April in each of the last 2 years. Again, things like initial jobless claims, earnings revisions, consumer confidence, economic expectations, something you just mentioned, in addition to the yield curve, a number of other points, they're all, again, flashing those warning signs. We may see another repeat of that same pattern in each of the last 2 years. Market up about 10%, only to give some of that back here in the coming months.
Are you seeing a lot of investors shifting their money into stocks because of low bond yields?
Not really. In general, when we take a look at the data, investors still, by and large, favoring fixed income assets over the equity markets. We've really not seen a big return to the stock market among individual investors. They still remain very cautious. Instead, it's been institutions, foreigners, hedge funds, others that have been really the big buyers of equities.
Jeff, is there still a ton of money sitting on the sidelines just waiting?
Yeah, you bet. You bet there is. It's been waiting for a while. It may wait a little longer. What I'd like to see is hopefully, you know, if we do get a little bit of a pullback, that a lot of that money begins to move back into this market. It's been a long time, and investors have not done a great job planning long term for their retirement. With bond yields so low, equities deserve a place in a portfolio for the long term, and hopefully, you know, we'll begin to see that money come back into the market, perhaps on the next pullback.
Jeff, the recovery here in the U.S. is tepid, but compared to Europe, at least there's a pulse. What headwinds do you feel could derail the recovery?
You know, there are a number of risks. Certainly, one of the biggest ones is the budget bombshell. It's not right around the corner, but as we look out to 2013, we've got rising tax rates, the expiration of the Bush tax cuts, new Medicare taxes, cuts in spending, that sequester that was put in place last year with the debt ceiling deal. All of that equivalent to 3.5% of GDP hitting our economy in 2013. That's the biggest fiscal contraction we've seen since 1947. That's not going to come without some economic pain. We've got to deal with that.
Jeff, we have about a minute left. Speaking of pain, Spain is officially in its second recession in 3 years. Its economy contracted 0.3% in the first quarter. How will the news impact domestic growth and profits here in the U.S.?
Well, it's interesting. You know, the real connection there is whether there's some contagion through the banks. We've seen earlier this month the big banks in Spain being downgraded by some of the rating agencies. To the extent that that has more of an effect financially across the world, that's the big risk. But the reality is we only sell 1/3 to Europe what we sell to the emerging markets. So if growth picks up again in China, that can completely offset some of the weakness we're seeing in Southern Europe. So it really comes down to the financial sector. All else, I think, we can manage the economic weakness in Europe.
Jeff Kleintop, he helps manage over $354 billion, chief market strategist, LPL Financial, joining us from Boston. Jeff, thanks for your time today. Thanks for helping us wrap up the month. Appreciate it.
My pleasure. Thank you.